For years, Bitcoin has been the Wild West of finance, a digital frontier where early adopters, tech visionaries, and retail investors took risks in pursuit of financial sovereignty. Now, that landscape is changing. Wall Street has arrived. With the launch of Bitcoin exchange-traded funds, traditional finance is stepping into crypto in a way never seen before. ETFs allow investors to buy exposure to Bitcoin through a regulated stock market product, making it easier than ever to own Bitcoin without managing private keys, cold storage, or security risks. This shift could bring a flood of institutional money into Bitcoin, pushing it further into mainstream finance. But it also raises an urgent question. Are Bitcoin ETFs a massive win for adoption, or are they the first step in Wall Street taking control of crypto? This book explores the potential benefits, risks, and hidden implications of Bitcoin ETFs, and how they could forever change the nature of Bitcoin investing. For those who have believed in the decentralized vision of Bitcoin, the arrival of ETFs could be seen as both a victory and a warning. If Bitcoin becomes too entangled with traditional finance, does it lose its core value proposition? If you're an investor, this video will help you understand whether Bitcoin ETFs fit into your strategy and what you need to watch for as they reshape the market. A Bitcoin ETF functions like a traditional exchange-traded fund, allowing investors to buy and sell shares of Bitcoin exposure through their brokerage accounts. Instead of purchasing and storing Bitcoin yourself, you simply trade shares in an ETF that either holds Bitcoin, known as spot ETFs, or tracks its price through contracts called futures ETFs. A spot Bitcoin ETF is backed by actual Bitcoin, meaning the fund purchases and holds real BTC on behalf of its investors. This structure creates direct demand for Bitcoin and can drive prices higher as more institutions allocate funds to it. Futures ETFs, on the other hand, do not hold Bitcoin directly. Instead, they use futures contracts to track the price of Bitcoin, which means investors are exposed to its price movements but without ownership of the underlying asset. The appeal of Bitcoin ETFs lies in their convenience. Investors can gain exposure to Bitcoin without worrying about wallet security, private key management, or exchange hacks. For many traditional investors, ETFs provide a gateway into crypto that aligns with their existing investment strategies. However, the downside is that ETF investors do not actually own Bitcoin. They hold a financial instrument that tracks Bitcoin's performance, but they lack true control over the asset itself. The launch of Bitcoin ETFs legitimizes Bitcoin in the eyes of institutional investors, making it more accessible to banks, hedge funds, and retirement funds. Before ETFs, many financial institutions were hesitant to enter crypto due to regulatory uncertainty and technical barriers. Now, with ETFs providing a regulated structure, billions of dollars are expected to flow into Bitcoin from institutional investors who were previously on the sidelines. This shift represents a turning point. Bitcoin has long been regarded as a speculative asset, but as ETFs integrate it into traditional financial markets, it could become a more established part of the global investment landscape. Increased institutional adoption means Bitcoin is no longer just a tool for tech-savvy investors. It's now being embraced by the same financial giants that once dismissed it as a passing fad. However, this also raises concerns. If Wall Street gains too much control over Bitcoin through ETFs, it could begin to influence the market in ways that contradict Bitcoin's original purpose. Bitcoin was designed to be decentralized and free from the control of governments and large financial institutions. With ETFs in play, Bitcoin could start behaving more like a traditional stock, subject to the same market forces that influence other assets in mainstream finance. One of the biggest effects of Bitcoin ETFs is the increase in market liquidity. Liquidity refers to how easily an asset can be bought or sold without drastically impacting its price. With the introduction of ETFs, Bitcoin now has massive institutional liquidity, meaning big money players can enter and exit positions more efficiently. This could lead to less extreme volatility over time, making Bitcoin more attractive to investors who previously saw it as too risky and unpredictable. The presence of ETFs also means that Bitcoin will become more interconnected with the broader financial system. Traditionally, Bitcoin has been viewed as a hedge against inflation and a safe haven asset during economic downturns. If ETFs make Bitcoin behave more like traditional financial assets, it may lose some of its independence from macroeconomic trends. Investors who once turned to Bitcoin as an escape from the banking system may find that it moves in tandem with stock markets instead of acting as a separate, decentralized store of value. Not all Bitcoin ETFs are created equal, and understanding the difference between spot and futures ETFs is critical for investors. Spot ETFs directly hold Bitcoin, meaning their price movements are based on the real supply and demand of the asset. This makes them more transparent and reflective of the actual market value of Bitcoin. Because spot ETFs require the fund to purchase Bitcoin, they can create significant buying pressure that drives prices higher. Futures ETFs, on the other hand, operate differently. Instead of owning Bitcoin, they track its price using derivative contracts. While this allows for exposure to Bitcoin's price movements, it can lead to discrepancies between the actual market price and the price of the ETF itself. Futures ETFs are also subject to roll costs, where contracts must be renewed periodically, sometimes resulting in unexpected losses for investors. For long-term investors, spot Bitcoin ETFs are generally the better option because they are tied directly to Bitcoin's real value. Futures ETFs may be useful for traders looking to take advantage of short-term price movements, but they carry additional risks due to the nature of derivatives trading. While Bitcoin ETFs make investing easier, they also introduce risks that many crypto purists find concerning. The biggest issue: investors in ETFs don't actually own Bitcoin. When you hold Bitcoin in an ETF, you don't control the private keys, meaning you're at the mercy of custodians like BlackRock, Fidelity, or Grayscale. This contradicts Bitcoin's core principle of financial sovereignty, where users are meant to hold and control their own assets. Another concern is market manipulation. Traditional finance firms now have leverage over Bitcoin's price action, as they can execute large trades without holding actual Bitcoin. Some worry this could lead to price suppression tactics, similar to how gold ETFs have been used to keep gold prices in check. For those who value Bitcoin's decentralized nature, the rise of ETFs is a double-edged sword. On one hand, they increase accessibility and adoption, but on the other, they introduce centralized control into an asset that was meant to be free from traditional financial influence. Bitcoin ETFs are a turning point for cryptocurrency, marking a new era where traditional finance and decentralized assets collide. They provide greater liquidity, easier access, and institutional adoption, but they also introduce risks of centralization and Wall Street influence over Bitcoin's future. The question is not just whether Bitcoin ETFs are good or bad, but rather what impact they will have on Bitcoin's identity as a decentralized asset. Will ETFs push Bitcoin into the mainstream, making it a standard part of investment portfolios, or will they dilute Bitcoin's original mission of financial independence? The future of Bitcoin ETFs will depend on how investors use them, whether as a tool for wealth building or a vehicle for financial control. As ETFs continue to evolve, the battle for Bitcoin's soul will unfold between those who see it as an investment and those who see it as a revolution. Are you ready to embrace Bitcoin ETFs, or will you stick to self-custody and decentralization? The future of Bitcoin investing is in your hands.